All right, we are live. What's going on, guys? So I've been doing a lot of thinking, really these last couple of days, and there's a couple stocks in my portfolio that I think I could maybe probably do without, and they're not bad companies by any means. You guys will see which ones I'm talking about in just a moment. There's two of them, but I think I would be okay if I remove them from my portfolio. So in tonight's live stream, I want to go through what both of these stocks are and explain some of the reasons why I'm potentially thinking about selling out of them. Nothing set in stone yet. I haven't come to any conclusions. And as we're going through this, I actually would love your guys' feedback. It'd be super helpful. So that's what we're going to do tonight in the live stream. But before we get to all of that, welcome to another Dividend Happy Hour. I hope all of you guys had a fantastic holiday yesterday if you celebrated. Mine was pretty low-key here in Las Vegas. This is the first time I've spent Thanksgiving or really any holiday, major holiday, away from my family, and definitely an adjustment, but still had a pretty good day, my girlfriend and myself. And tonight I am not, I'm keeping it clean tonight, guys. I'm just having a nice cup of tea out of my favorite mug here. So take a sip of this real quick, but let's do a quick cheers to the Dividend Happy Hour. So here's to what should we cheers to, guys? Let's cheers to a long weekend, because I think that's one of probably the best things of the holiday season is we get, a few pretty long weekends back to back. Hopefully you guys have, I'm sure a lot of you guys had yesterday off and hopefully had today off and, get the next couple of days off. So here's to that. Nice little rest. Okay. And also, too, before, we get into everything, couple more things. Let me know where everyone's watching from tonight. Maybe we got some neighbors out there. It's always interesting to see where the dividend investors are coming from. And also, let me know what you guys are sipping on tonight for the Dividend Happy Hour. What did you bring to the stream? I want to hear from you guys. And I'll do some shout outs real quick to you guys who are here in the stream so far. Who do we got here? We got Kevin. What's going on, Kevin? Riaz. Hopefully I pronounced your name right, my friend. Girl Dad Dividend Investor, what's going on? Coyote in the flesh, as usual. My main man Suzuki's in here. Paolo, Steven, Jim, Dan, Wilmer. Homeless Man, what's going on? Charles, Jay, Mr. Kevin Burgess. We got Steve C. Julius Caesar, what an honor. Craig, what's going on, Craig? Joe, how you doing, my friend? Did I hear shout out Charles? If not, Charles, what's going on? Maybe you get a second shout out. G-Man. Good to see you, G-Man. And then we got Bob over here. Bob, it's good to see you in the stream tonight. But yeah, let me know what you guys are sipping on and whatnot. I see Charles is sipping oh, no, that's not it. We got Joe actually sipping on a Mountain Dew Voltage. Wow. Some caffeine Friday night. Some homeless man's drinking a fat glass of water with a pH, so it's a big boy over there. We got Kellen drinking a Modelo. We got Brandon drinking a Sierra Nevada Classic Choice brewery out of Chico, California, which is like 45 minutes north of my hometown, Yuba City. No one knows where Yuba City is, but it's about 45 minutes between Sacramento, California, which is the state's capital, and Chico, which is like, so it's like 45 minutes wedged between both of those. So yeah, kind of a fun fact, I guess. But anyway, guys, for those of you who are just now joining, thank you so much for tuning in tonight. I'm going to be talking about a couple stocks that I'm thinking about getting rid of in my portfolio. I'm not 100% sure yet. We'll see. But once again, guys, as we're going through these couple of stocks, there's only two of them. Let me know your thoughts, because I don't know. I really just started thinking about all this stuff maybe within the last couple of days. And yeah, I don't know. I could use, I guess, a fresh set of eyes on the whole thing, a fresh opinion. And I know you guys always steer me in the right direction. So I'm happy to have you aboard. But anyway, I guess without further ado, guys, let's get into it. I don't have any, unfortunately, I don't have any dividend milestones to shout out. No income milestones, no portfolio milestones this week. It was overall a pretty quiet week, I guess, for us dividend investors. But anyway, guys, let's go over to the screen real quick. I'll show you my portfolio. So these are all of my holdings on my Google spreadsheet, my free Google spreadsheet, actually, which you could grab for free. It's got tons of cool pages right here. This is the dashboard. What we were looking at just a moment ago is all my different stock positions. This thing shows diversification. It's not, you guys, the version you guys can get, it doesn't have this. I have not updated that yet. You get a dividend log to track all of your dividend income, a nice little watch list, and a future value calculator to, predict what your portfolio is going to look like 10, 20, 30 years down the road. But you guys can get access to all of this. Once again, the spreadsheet is free. There's a link to it in the description. You just got to sign up for the weekly email newsletter, which I think is, a small price to pay. I hope you guys enjoy the newsletter. And real quick too, like if you guys have not signed up for the newsletter yet and want to get that, it's going out every Thursday morning. Put out yesterday. Yeah, yesterday. I think it was my best one yet. But you guys sign up for the newsletter. I'd love to stay in touch and get that sent to your email every week. Once again, links in the description, but you can get the spreadsheet along with that. But anyway, let's go back over here, guys. So the first stock, I guess, without further ado, and hopefully you guys can see that okay. I think I'll zoom in just a little bit more so it's a little more clear. So the first stock that I'm thinking about getting rid of, guys, is actually WP Carey. And also just a disclaimer, I don't know if I mentioned this earlier, but neither of the stocks I'm selling are, I don't think they're bad companies at all. I think they're pretty good investments. But the first one here is WP Carey, which is a real estate and investment trust. And along with Realty Income, it was one of the first stocks I really added to my portfolio. And right now I just have over 17 shares and my position's doing pretty well. I mean, just market return, just talking about share price, I'm up 16%. But if we include dividends in that number, I'm up about 26.5%. So my total return without dividends is about $200. My total return with dividends is about $300, just over $300. And in total, I've received about $123 from this position since I've owned it. And it currently makes up just under 4% of my total portfolio dividend income. And as far as its allocation in my portfolio too, it's not a really big position, 3.3%, which is another reason I'm kind of considering selling out of it because it's really not a big position. I'm up quite a bit, and it's, I guess really, guys, when I look at this position, I compare it a lot to Realty Income up here. And that's kind of what we're going to do for the next couple of minutes, just compare these two stocks. I mean, starting just with the portfolios right here, I feel like I have a better grasp on the different tenants that Realty Income has and the industries that it's in. I mean, kind of before we get to that, just looking at WP Carey, I mean, the diversification of their portfolio is not too bad. Very retail heavy, not too bad. 20% of their portfolio, consumer services, okay, that's fine. I'm not too concerned about how this is diversified. And if we scroll down and look at their top 10 tenants, there's some decent ones in here. U-Haul, okay, that's a great company. But then there's some other ones that I don't really, I don't know a lot of these. State of Andalusia, which is a property in Spain. Metro Cash and Carey, I'm somewhat familiar with them, I think, or maybe not because this is in Italy and Germany. Maybe I'm thinking of something different. Hellwig, Extra Space Storage, I do know this company. We've got Marriott, obviously the hotels, that's a big tenant to have. Excuse me, guys. I don't know why that highlighted. But then there's these other ones here that I'm not really too familiar with the exception of Advanced Auto Parts as well. But then we compare that to Realty Income, who's really their roster of tenants I'm more familiar with, I understand them more, and I think I would just feel more comfortable putting more eggs in this basket, I suppose. I mean, if we take a look at some of Realty Income's tenants, maybe I can zoom in here. Hopefully you guys can see that pretty well. Some of Realty Income's tenants, like 23% of them, Walmart, Kroger, Costco. I don't know this company. Dollar General and Dollar Tree, Amazon, and then tons of other ones, guys. But, definitely more household names than what we're seeing there with Realty Income. And even so, just if we're looking at the type of businesses that they lease out to, it's grocery stores, convenience stores, dollar stores. I think that these are more, and quick service restaurants like KFC, probably other fast food, and then drug stores as well. Maybe like some CVS's, maybe some Walgreens. I don't know that for sure, but stuff like that. But anyway, Realty Income's roster of tenants are ones, like I said, that I feel like I understand more. I'm more comfortable with them. I think it's a stronger roster of tenants, at least the ones that we saw there so far. And so that's one of the big reasons that I'm thinking maybe I don't need WP Carey. There's probably some crossover in how their portfolio is diversified by industry. Maybe there's a lot of similarity there. And I'd rather just put more eggs into Realty Income's basket because it seems to me to be kind of a stronger stock. I mean, if we go over and just compare the stocks side by side using the stock comparison tool on Seeking Alpha, which is one of the premium features. And if you guys have ever wanted to try out Seeking Alpha Premium, there's a link in the description of this video for a free 7-day trial and also a discount if you decide to continue on with it from there. It's been essential for me as an investor. I love having the premium version. But Anyway, comparing these two stocks, Realty Income and WP Carey, scrolling down, we're just going to look at the dividend stats. We're going to look at the total return and some of those sort of things. So Realty Income, I mean, in the last month, it's been, they're right in line with one another. Even not year to date. WP Carey is actually outperforming year to date. But if we zoom out across a longer period of time, well, no, actually WP Carey, as far as share price, is still beating Realty Income or in total return. So, I guess WP Carey does take the cake there. And WP Carey also does have the advantage in terms of dividend yield. They have a higher dividend yield than Realty Income, but I wouldn't turn your nose up at Realty Income's dividend yield. 4.61 is still pretty respectable. And also they're offering more dividend growth than WP Carey by almost 4 times as much dividend growth, at least in the last 5 years. And furthermore, Realty Income has a much longer track record of growing this dividend. They're officially a dividend aristocrat compared to WP Carey that only has 8 years of consecutive dividend growth. Okay. And having said that, neither of them are bad. Like, these are pretty good dividend stats. These are pretty good dividend stats, But then scrolling down, just looking at some of the growth in the financials, I mean, revenue year over year, Realty Income's just destroying. Even if we look at across a compounded annual growth rate across the last 5 years, Realty Income is bringing in or doing double the revenue growth on the top line than WP Carey. And it doesn't show the funds from operation, which is the bottom line, kind of like the real estate investment trust version of free cash flow. The FFO is what they use to pay the dividend. But I know Realty Income's is growing steadily, like across the last 10 years. Their bottom line's looking really great. And so, these are just some of the things. Whoops, excuse me, guys. These are just some of the things that I'm considering. Oh, shoot. I didn't even have it on the screen. I'm so sorry, guys. I'm such a goofball. Let me go back over here. We'll go through it really quickly. Just the dividend stats at least. Gosh, I'm so silly. I feel dumb for that. But yeah, look at these dividend stats. Let's zoom in here a little bit, make it bigger. So WP Carey, bigger yield, okay? But Realty Income's got 4 times the dividend growth across the last 5 years and has 3 times the dividend growth history. Aristocrat versus 8 years of dividend growth. That's pretty much the main thing. But all in all, guys, I feel like they're pretty similar real estate investment trusts. And, I do like them both, but I also don't feel like I need them both. And if I had to choose one or the other, guys, Realty Income is it's like the gold standard for real estate investment trusts, right? So, if that's the case, I'm thinking about selling out of WP Carey, maybe putting some more eggs in the Realty Income basket. And furthermore, guys, I have another really great real estate investment trust in my portfolio that I could deploy those funds into, and that's KRC. And honestly, I know it's starting to pick up a little bit. Some of you guys are starting to come around to KRC, but it's still slept on in my opinion. I mean, this stock, guys, this real estate investment trust, super low P to FFO, 8.9, so it's very cheap. We'll look at some other valuation stats too. Just looking at the price to book once this loads in a second. If it loads, actually. Sorry about that, guys. I don't know why, I don't know, maybe it's my internet or something, and let me just make sure, yeah, okay, I am on the screen. But look at the price to book right here for KRC, 0.89. So this real estate investment trust is currently trading below its book value. And furthermore, if we go over to the financials page, just looking at the balance sheet, KRC is doing really well in terms of book value per share. This is going up steadily over time, and I know that kind of cuts it off. But if we zoom into this chart right here, you guys see that right there. Oop, where are we at here? Excuse me. Right here, guys. That's looking really good. Very steady growth in book value per share. And the balance sheet overall is looking pretty good. They have a lot more assets than they do liabilities. About 10.6 billion in total assets compared to about 4.9 billion in total liabilities. And furthermore, they have no current debt, which makes sense. Real estate, a lot of it's going to be long-term debt. Which is increasing over time, but that just means that they're acquiring more properties, which we also see. We can see right here more, that's going up right there, the property plant, whatnot. But even so, going on to the income statement, just looking at the top line, rental revenue is increasing very steadily, okay, on the top line. The bottom line, we're seeing the same trend. The FFO, the funds from operation, look at this nice slope upwards, guys. We are doing pretty good there, and that's just getting paid to us as shareholders. And so we are seeing some nice dividend growth from that as well. We can see the dividend per share is increasing, and they have a pretty nice dividend yield too. I think it's in the 5s maybe. Yeah, 5.23%. So this is even higher than WP Carey's, and they have a higher 5-year growth rate, and they have a pretty similar dividend growth history. So I think by selling out of WP Carey, I'll be able to deploy some of those funds in, if I was just to put it all back into, other stocks in the real estate sector in my portfolio. Realty Income, okay, that's not going to be a bad move. KRC, similar dividend stats, still seeing really strong financials, very strong balance sheet, similar dividend similar yield. So I'm not losing out on income. In fact, I might even gain some on income because it has a higher yield depending on how much I deploy. So, that's stock number one that I'm thinking about selling out of. And I see, just kind of a sidebar real quick, I see Steven right here says I should sell out of ORCC. That's for a whole nother video. And trust me, my friend, that's crossed my mind, but I don't know if I'm quite ready to do that yet. But anyway, guys, that's the first stock. And once we go through this, go through both of these stocks, this next one as well, I'll come back and check out some of the comments that you guys leave me here. Because I really want to see what you guys have to say about both of these moves or potential moves. But anyway, going back to the screen real quick, guys, going back over to my portfolio, the second stock that I'm thinking about selling out of, and you guys might think I'm out to lunch on this one, but Lockheed Martin, okay, very strong company in the defense industry. Lockheed Martin, LMT, I currently have 3.7 shares at an average cost per share of about $350, which is quite a bit nicer than its current share price, near $500. And as far as my current return with this, just from a share price gain perspective, I'm up almost $500. But if we include dividends in that, I'm up about $530 or so, with a market return of 38%, total return of just over 40%. And this, once again, is not a very big position in my portfolio. 4.29% of my total allocation. And then in terms of income, it's quite low, 2.3%. Now, the reason I'm thinking about selling out of this stock is because I have exposure to Lockheed Martin in my Roth IRA through SCHD. In fact, if we go take a look at SCHD's top 10 holdings real quick, excuse me as I pull this up, guys. If we go look at SCHD's top 10 holdings, we'll see that Lockheed Martin makes up a pretty similar allocation in SCHD as it does in my portfolio. So once again, just for our reference here, so we don't forget, Lockheed Martin currently makes up about 4.3% of my total portfolio. And if we look here, Lockheed Martin is about just over 4% of SCHD's total, total allocation right there. It's one of the 103 holdings, and it's number 1, 2, 3, 4, 5 on its top 10 biggest holdings. So, it's got me thinking, over a long period of time, the bulk of my Roth IRA is in SCHD. I believe I don't know if it's 50%, but I do think it's somewhere between 40 and 50%. I'll have to double check at another time. Let's just say it's 50% because I actually think that might be it. But, and I'm going to be investing in this over a long period of time. And so I just don't know. I just don't know that I need Lockheed Martin in my taxable brokerage account with all the individual stocks when I'm going to be adding to it on a weekly basis. When I'm adding to it on a week, sorry, I'm just reading the comments, getting a little distracted. I'm actually going to move that for a minute. Okay, I'm so sorry, guys. So I don't know that I need it in my taxable brokerage account if I have that much exposure to it in my Roth, and I'm adding to that every single week, with most of those contributions going to SCHD. So, if A equals B and B equals C, then I'm adding to Lockheed Martin every single week. So hopefully that makes sense. Plus, I'm thinking about it when the quarterly earnings come out, every quarter. Lockheed Martin, just since I bought it, it's not been one of those stocks that I've really had an interest in keeping up on. And I think in part that's just because I know it's good. Like, I don't have any concerns about it. And it's providing steady cash flow, that's for sure. And the dividend stats are looking pretty good from what I remember. The yield's nothing crazy, but I do believe that they have a nice growth rate. But then again, I've got some other great stocks in my portfolio offering pretty substantial dividend growth. Lowe's, Starbucks, Snap-on. What else? I got a handful more that are offering some pretty nice dividend growth that I could reinvest those funds into. And at the same time, it would be nice to consolidate a little bit and maybe, maybe clear some of the bulk down and maybe make room for some other positions that I have my eye on, which I'm excited, you guys. In a couple weeks, next week, I'm going to be putting out my monthly portfolio update. I cannot wait to show you what I've added to my watch list, because there's a few stocks I'm really excited about. And Joel Batista, I see you in here in the live stream or in the live chat. I think you're going to like a couple of these ones that I share. So you guys stay tuned for that. But anyway, that's kind of why I'm thinking maybe Lockheed Martin might not be another one to sell out of, especially considering how much I'm I'm currently up, 500 bucks. Like for me, guys, that's not nothing. And I do think it's going to be a great hold, but I've got it elsewhere. So I don't know. And that's where I could use your guys' help. Like, what do you guys think? And at the same time, having said this, like, that's not to say that I couldn't ever buy back into it in the future if I changed my mind. And who knows, maybe it'll come down in share price because truthfully, I bought into this stock at a pretty good time. Like I bought in unknowingly. I bought in, I think, right before like the whole Russia-Ukraine thing broke out. And then once that happened, like it just really took off. So, it might not be a bad opportunity to lock in some gains and close in on some profits. But if I do this, I don't know if I might wait until the turn of the year to do so. This is something I still need to think about because I'd rather just be hit with that capital gains tax next year, like at the end of 2023, or instead of paying it this next time around for when I do taxes. So I don't know, just things I'm thinking about. But yeah, let me know your guys' thoughts on both of these in the live chat, por favor. And also, if you're watching the replay, let me know in the comments below what you think. I'd really love that feedback. And now I'm going to go through some of these comments and pull them up on the screen and just see what you guys have to say about all of this. Okay. Okay, let's see here. Take a sip of my tea. It's already getting cold. Okay, so Caitlin right here says, I think it's a good time to exit both WP Carey and Realty Income. Both trading above 15% FF or 15 times FFO, and there are just better deals on the table, even if you limit yourself to only dividend payers. Yeah, they'll be cheap again one day. Yeah, and I don't really want to get in the habit of like buying in and out of certain positions. Like I really like Realty Income, and like I don't know. I really don't see a reason to sell that one even though I'm up on it. I'd rather just hold and keep collecting the dividend from it. Okay, so Jay here says, I think WP Carey is safer than Realty Income in terms of tenants, but Realty Income has better management. WP Carey hasn't had a return on investment as high as Realty Income. Yeah, and see, like I don't know. Like just because I'm not as familiar with a lot of WP Carey's tenants. And once again, I bought this just as a disclaimer. I bought this stock quite some time ago, like when I first got into dividend investing, or maybe soon after. It wasn't one of the first stocks I bought, but I did buy it pretty early on. So this was before I really, and I still probably will, like this time next year, I'll be doing deeper research than I am today. But yeah, I was not researching companies as in depth as I am today. And if I could go back, like I'd spend more time looking into that stuff. And that was my mistake. Maybe it's not even a mistake, I guess, because I'm fine with WP Carey. I've done pretty well with it. So I don't know. I dropped KRC first. Real estate in San Francisco and Los Angeles is not a pretty picture. I mean, the sentiment around it I understand, but KRC's numbers, the numbers they're putting up both on the top and bottom line, and also what I'm seeing come out of the earnings reports, like point to the opposite. Like they're still looking very strong. Steven says thoughts on Ben, super cheap aristocrat. So I'll touch on this real quick and then I'll get back to your guys' comments. Okay. So, but Steven, thank you so much for the $5 super chat. I really appreciate it, man. Let's take a look at Ben real quick. Okay. I actually was looking at this stock yesterday or a couple days ago. So just looking first at, let's just take a look at the valuation because that was the first thing that was mentioned. So it's a financial stock. So the PE is not, the first thing we maybe want to look at. The price to book is 1.12, which is not too bad at all. Like it's trading near its book value, which is 14%, and the price to book is 14% lower than the sector median, 17% lower than the 5-year average. So that looks pretty good. But let's see what the financials are doing. From what I remember, it's kind of flat. This is interesting to me. So at least for the last, can you guys see this okay? Yeah. For the last 10 years, guys, and actually let me do this. This is just easier to see it this way. So without hovering over the chart, because I don't want it to pull, because I don't want that to happen. Excuse me. The revenue is interesting because for most of the last 10 years, it was trending down with the exception of the previous 2 years, or really this year and last year, 2022 and 2021. And I haven't done enough research into this company to know exactly why that is. Excuse me, guys. I don't know what is going on. But then we scroll down, like one good thing about Franklin Resources, they're buying shares pretty aggressively. That's great. And I think T. Rowe Prices as well, which is a company very similar to Franklin Resources. And they're seeing some nice dividend growth there. Yeah. And the payout ratio is not too bad either. Like historically pretty dang low. Okay. 45% as of late. So that's good. What's the balance sheet looking like? I think they have negative debt, if I remember correctly. Yeah, they do. So this company doesn't have, well, they have total debt. They have some debt, but on a net basis, like the debt's non-existent. So that is definitely comforting to see. And what's the net income looking like if we go over to the statement of cash flows? And, this is kind of interesting too. It's kind of been hit or miss, a little sporadic here. Definitely trending down the first half of this last decade. And then since there, it's been kind of sporadic. Some up, some down. But not too bad. And looking at the dividend stats, I think they have a pretty good dividend growth history from what I remember. Yeah. So 25 years of dividend growth. They're an aristocrat. The dividend yield's looking really nice, 4.37, with a 5-year growth rate that's really not too bad either, 7.7%. So I like Franklin Resources, actually. I think this is a pretty good company. If we look at the profitability, we'll see that they are decently profitable. Okay, the return on equity, they're not giving that the best grade, about 11%. This is a little bit lower than the 5-year average, and so is the return on capital and the return on assets. So, but I'm thinking that maybe has to do just with the state of what's been going on in the market this last year, right? So from my understanding and from what Franklin Resources does is they're an asset management company like T. Rowe Price. And so when the market goes down, so do their assets under management, which then I would think would decrease their revenue, but that's not what we saw in the financial statement. So I don't know, like I'd have to spend more time with it to really give you a good answer on Franklin Resources, but the dividend track record's definitely there. I will give them that. But Stephen, once again, thank you so much for the $5 super chat. You're the man. Now let's go back up to WP Carey versus Realty Income, guys. Okay. But yeah, Bob, sorry, going back to your comment, I feel great about KRC. I don't have, at this point, I understand what you're saying, but I don't have any issues with them. Plus, they're not just in San Francisco and Los Angeles. They're also in Seattle. They're also in San Diego. They're expanding to Austin, Texas. And the thing about KRC too is their properties are so unique, and it's actually interesting. So they recently expanded into the Austin market, and the reason they did so was because their pre-existing tenants who were moving from the Bay Area basically asked them or told them hey, you guys should come to Austin. If you were to move into Austin, we would definitely rent from you guys. And that's what prompted them to get into that market. And so there's something about their properties that stand out from your average office building. And I also think it'd be a mistake to say, I know what the sentiment is around, office buildings right now. I understand that, the whole work from home thing. But that's not set in stone. Like we're seeing a really interesting shift in the whole work from home thing. I think, and I'm interested to see how this plays out, but a lot of employers are wanting to bring their staff back to the office just because it tends to be a lot more productive. But anyway, I won't go into too much more of a rant on KRC unless prompted to. But yeah, I mean, that's a valid point you bring up, Bob. I'll give you that. What else we got? Oh, yeah, and Chantel, that could be true as well. Like Seeking Alpha sometimes is tripping on their dividend stats. And just to confirm, let's go back over to WP Carey real quick. So she says Simply Safe has them at 23 years of consecutive dividend growth. But let's go back over here to the dividend growth history page and just see what's been going on, because that will tell us a more honest answer. And yeah, that looks to be right, unless there was a period somewhere in here where they just paused the dividend growth. I don't know. But yeah, I guess over a longer period of time, they still have grown the dividend, albeit slower than Realty Income. If we just look at the trend, the growth chart on Realty Income, we can see that this is a bit more steep, and it's also, obviously the length of time appears to be longer as well. So, but yeah, thank you for bringing that up. I forget that sometimes Seeking Alpha does they're not always the most accurate with the dividend growth histories. So let's see here. Oh, Charles said peanut. Was he in here? Did you guys see the cat running around? I haven't seen him. I thought he stepped out for a cigarette a few minutes ago. He told me he was going out. Big Friday night. Let's see here, guys. Jay's like, Ryan trying to lock in some gains. Yeah, you know, maybe. Maybe. I'm thinking about it. Okay, Michael's in it to win it. I'm all right with that sell. Get them gains. All right, man. So Michael's on board. If Michael's on board, then, hey, man, maybe I'll just do it. He's never steered me wrong before. Okay, but Shaping says I should sell ORCC. And I get it, guys. Like, I understand. You know, I get it. But ORCC has been good to me. Well, but, you know. And honestly, that one, when I think about consolidating my portfolio, just truth be told, that is one that I often, in my mind, put on the chopping block. I put that one on the chopping block right along with JEPI and XYLD. And there will come a time, I'm sure, when I want to consolidate more and get rid of those and reallocate them elsewhere. I'm just like, and this is bad, it's a psychological thing. I just don't want to take the big hit in dividend income because those are all high yielders in my portfolio. And I actually like ORCC. I'll have to do a video on it. I'll have to do a video on it here soon and talk more about it. But I do like ORCC and I like having it in my portfolio. Yeah, so, and I think this is a pretty level-headed way to look at it. KC says, I think LMT is fine as a hold here, but if you don't love it enough to dedicate a position to it outside your ETFs, it's not so amazing that you'd be crazy to sell. Lots of better stuff out there. Yeah, and you know, I've got, like, I consider Lockheed Martin to be a high-quality stock, for sure, but I've got some other ones like that in my portfolio that I wouldn't mind building bigger positions in, and I could use those funds to do so. So anyway, so Jim says hold on to it, especially if I don't have any defense stocks. But here's the thing, like you might have missed this earlier in the stream, Jim. One of the reasons I'm selling LMT or would want to sell LMT is because I have it in my Roth IRA through SCHD, and the allocation of Lockheed Martin in SCHD is like pretty much the same as how much I have allocated in my taxable brokerage account. You know what I mean? So that's, you know, and then Kevin brings up a good point too. Is it all or none? What if you trim the LMT position? Yeah, I mean, I could, but one of the big reasons the biggest reason I'm considering selling it is because I have exposure to it in the Roth IRA through SCHD that I'm still contributing to every week. So still on a weekly basis, I'm adding to Lockheed Martin through that. And I don't know if can you look at it like that? Like, is it fair to look at it like that? Or is it different when you're buying it through an ETF versus on an individual basis? I don't know. Let's see. But this is the thing too, like it really is a good company. Every time I look at Lockheed Martin on Seeking Alpha, you go on there at any given time, like the top news. Let's just do this because it's you guys will see what I'm talking about. It's probably just easier to show you instead of, you know, my normal gibberish. So scrolling down, okay, there's always like a handful of these. New contract, okay. What else we got here? New contract, 765 million. New contract, 582 million. New contract, 281 million. New contract, 100 million. So it's like, you always see those for Lockheed Martin. So they, you know, it is a good company. This is why I'm so torn, guys. I don't know. I don't know. And yes, Kevin, man, thank you. Or no, not thank you. It's good to have you back. I'm looking forward to seeing a video from you soon and hearing about your travels. For those of you who don't know, Kevin was in Israel, I believe, recently. And the internet missed you, man. But yeah, I'm looking forward to hearing about your trip. Yeah, and so like Ben brings up a good point with JEPI. Like, is there any reason why you have it? Not not a good reason, honestly, Ben. Not a good reason. And that one could be on the chopping block along with XYLD and with ORCC. But, guys, across all of my holdings, across my entire portfolio, I feel like I have a really strong balance between all different kinds of dividend stocks. High yielders with no growth, lower yielders with high growth, more very stable ones that don't have super high yield, super high growth, but are just, you can count on them to be there, like the Procter and Gambles. I feel like I have a really strong balance between all those different kinds of dividend stocks. And I like that. I like having that balance. And I think, different stocks have different things to offer. And, I like having exposure to all those different kinds for now. And I get it. Like, I'm younger, should be focusing on dividend growth. I am. But through this balance, guys, I think my portfolio has a very good balance between being, offering a nice yield. It's about upper 4% yield. And my dividend growth across my entire portfolio is nice as well. On average, I think it's about 7 to 8%. So, I like those stats. A high yield with a pretty moderate growth rate. That's only made possible by having the balance in my portfolio that I do. And at the same time, I think I've got a solid batch of stocks that offers stability and reliability. So I'm even though I have some of the JEPIs, the XYLDs, and the ORCCs, I think that they serve a specific purpose in my portfolio, which is why I'm fine holding them for now. And I think my reasons for maybe thinking about selling out of Lockheed Martin or selling out of WP Carey are different than reasons that you guys might have for maybe me selling out of ORCC or JEPI or what have you, if that makes sense. Okay, I want to hear, what was the other stock? Oh, no, we pretty much covered both stocks actually. So this is pretty much it, I guess. I don't see too many more comments about all this, those two stocks. So let me get into some of the other comments. I'm going to scroll all the way up to the top because I know there was some really great questions, and it's about 5:40. Guys, we might have to go a little bit longer tonight. I'm sorry. I might have to do it though. We might have to push it past 6 o'clock to get through all these questions. So let's see here. Going up to the top, let's find another question. Just now we're getting into like the general Q&A, guys. And real quick, if you have not done so already and you guys are enjoying the stream, all 120 of you, which honestly, this might be the most people we've had in a stream before. So thank you guys so much for tuning in. I appreciate all you guys. And if you're loving this, if you're having as much fun as I am, like hit that thumbs up button for me one time, or maybe even twice if you have the capacity to do so. If you're a miracle worker. Okay. Let's find some other questions here. Okay, let's see here. I think I scrolled too far up. Hang with me, guys. Hang with me for a moment. Let's see. Man, I definitely scrolled up too far. Let's see. Okay, this is a good question. So any European stock to look for? I don't know. I don't have too much experience looking at European stocks. I will say that there's one I was kind of looking at for a moment. Oh gosh. What was it? Okay, it's the company that owns, I'll find it for you real quick. Oh yeah, this is it. Okay, hang tight, guys. I'm gonna get the ticker symbol. It's called, the company is Richemont. Yeah, there it is. Okay, I'm gonna pull it up on the screen. So this is like one of the only European stocks I've ever seriously looked at. And this is the company that owns different luxury brands like Cartier. They own Van Cleef and Arpels. They own IWC, Piaget, Mr. Porter, which is an online, basically luxury retailer. Montblanc makes, iconic pens and watches. So basically they own a lot of timeless high-end luxury fashion companies. And some of these ones like Cartier, like some of these are very timeless and aren't really cyclical, like Cartier, Van Cleef, Mont Blanc, and Mr. Porter being a retailer, they sell a ton of different brands. IWC, a lot of these guys are ones that are pretty much always in style, I guess you could say. And I was looking into this company, like the dividend stats, I don't remember them being that great. Yeah, so it's like less than 2% yield, not much to speak of in growth, and then 2 years of dividend growth. And what were the financials like? I don't really remember. Like, yeah, the revenue's kind of growing. I don't know. I like the idea of owning, a company like Cartier and having something like that in my portfolio, because it's not just like, Cartier is not just like nice discretionary sort of things that are cyclical. They also are big into like weddings, wedding bands, wedding rings, stuff like that type of jewelry. And so are some of the other companies that they own. And weddings obviously is like a pretty non-cyclical industry. Let's see here. But yeah, other than that, like I don't know too much about European stocks. I know a lot of people like Hormel. I think that's a European stock, right? Let's see here. Let's keep it going. Okay, Hulkman, good question. So how much do you invest annually? Let me crunch that number for you. So, I actually know it. I think it's like 7,800, but let me confirm that real quick. So 200 times 52. Well, if we're including what I contribute to the Roth IRA, then I'm investing just over $10,000 a year. And over time, as my income grows, I'd love to be able to invest more. But I got to keep working on growing my income. But I'll tell you what, if you guys keep it up with those super chats like Steven tonight, we'll get there sooner than later. Steven, once again, thank you for that, man. And I'm just messing with you guys. Like, you don't need to super chat me. Like, I'm not going to hold a gun to your head and make you do it or anything, Let's see here. Woodland, LW, shout out Woodland, California. Not too far from my old neck of the woods. Woodland's nice. What's that one restaurant in Woodland? I used to do a lot of the marketing for the city of Woodland. Let's see here. Okay, this is a really good question, actually. It's Vans wants to know, hey, Ryan, love your videos and have been watching for a few months and also want to join the finance side of YouTube. Any advice on how to start with video ideas? Great question, man. I love talking about this stuff. If you guys have any questions about YouTube, like I'm an open book, and also I'm a huge advocate for starting a channel. If any of you guys have ever thought about it, like it's been a really fun thing to do, and it, you never know what these things can grow into. So, I highly recommend anyone who's thought about it at least giving it a shot. But to answer your question, like where to start with video ideas, model what works. Like take a look at some of the creators that you look up to and just see what type of videos are they making. Are they portfolio updates? Are they stock lists? Are they talking about dividend income? What are they doing? And then maybe, a good place to start would be to try to emulate those sort of videos, not copy per se, but, like I do monthly portfolio updates. I know other people do portfolio updates. I do dividend income videos. I know other people do dividend income videos. And I think that's great. Like those are great places to start, just talking about what you're doing and, maybe the stocks you're buying or what you're looking at buying. I think those are great places to start. And then, over time you'll find your groove and, you'll develop your own style and the things that work specifically for you and your channel. But dude, it's a lot of trial and error. Like even I've been doing this just over 2 years now, actually, consistently. And it's still like you learn something new every single video, what works, what doesn't work. And, so yeah, it's a interesting journey to say the least, but so worth it and so much fun. But yeah, I'd highly recommend anyone starting a channel if they've ever thought about it, or even a podcast or a newsletter or a blog or whatever, the thing too is like doing this stuff, just talking about this really helps other people stay motivated and helps other people get into investing. I think, I wish more people were dividend investors or got into dividend investing, especially new investors who, start throwing some money into a portfolio. I think more people should start investing with this sort of plan than some of the other, or this sort of style of investing than some other things they could be getting into, like the meme stocks or the cryptos. And the more people talking about it, the more likely we are to capture those newer investors and hopefully show them a more sustainable, more responsible way to invest when first starting out, instead of just getting wrecked on some of the hype stuff, you know. Let's see here. G-Man wants to know, are you chopping Jeppy? No, I mean, not at this time, but I go back and forth on it. I don't know. Time will tell. At some, like, I don't see myself holding it forever, but for now, I don't mind. For now, I don't really mind just collecting that monthly income. Selling LMT and holding ORCC is chasing yield. Let's be honest. I mean, yeah, and to be honest with you, I really don't think ORCC is like a bad company to own. And my reason for selling Lockheed Martin has nothing to do with yield, or maybe selling Lockheed Martin has nothing really to do with yield. But my reason for keeping ORCC is because I like the income. But like I said earlier, like, different stocks have different purposes. Like, you know, Altria Group's got a high yield. You know, Realty Income's got a high dividend yield as well. WP Carey's got a high dividend yield. So, you know, just because a company has a high yield doesn't mean it's a bad company. You have to look deeper into to really to know for sure. But I think different stocks have different purposes. And for me, like, I'm okay holding ORCC, knowing that I'm going to benefit more from the income than I will from the capital appreciation from that particular holding. Now, that's not to say that all of the stocks in my portfolio are like that. And that's not to say I have a huge position in ORCC. It's actually pretty small. I think it's less than 3% of my portfolio. Yeah, I don't I don't know. I disagree with you. Well, I agree with you that it's chasing yield, but I think in this context, it's not, like, there's nothing wrong with it. Let's see. Michael, I like your portfolio, Ryan. Loving the journey. Thank you, man. I appreciate you. Yeah, and, you know, Ben, I think it's okay to have some high yielders in the portfolio. You never know when you might need some income. And what I do with well, all of my stocks is I capture that income and deploy it into other positions. So it's not like I'm getting that high yield and throwing it back into ORCC. I don't need to justify my ORCC position. I'm fine with it. I think it's a good company. It's done well for me so far. And, you know, I'm going to continue to hold it the same that I'm going to continue to hold Main Street Capital Corporation, both business development companies. I'm still, like, my portfolio is still benefiting quite a bit from capital appreciation. At least for the last couple years, I'm technically outperforming the market. So this balance seems to work quite well for me, so far at least. Kellen, this is a really good question. What do you think is a good amount of stocks in your portfolio? I think it depends. Personally, I have like 23 stocks at this point in time. And that feels pretty good. I wouldn't like to have, and I have about a $40,000 portfolio. I wouldn't like to have like 40 or 50 at this point in time, but I do think as your portfolio grows in size, it's natural to expand those positions. And that's probably the approach I'll take. As I get older and this portfolio continues to grow, I'll probably expand the holdings just to have more diversification and protect and insulate that income a little bit more. That's kind of my long-term approach for this portfolio, I think. But how much is good? I think it just depends on you individually. I think it's kind of preferential for everyone. But it also depends on how big your portfolio is. Like, I wouldn't have a $1,000 portfolio and have 40 different holdings. Like, if you're just starting out, and if I could go back in time, this is probably what I would have done. I would start with like an ETF and maybe add a couple individual or a few individual stocks outside of that, and then just rock with that for a little bit. Ooh, Hugh, good question. Great topics. What do you think about Canadian bank dividends? I don't know a lot about them. I've heard they're very good, and I plan to make a video on them at some point. maybe next month. No, not next month. Maybe sometime in 2023, I'll make a video on Canadian bank stocks. There's 5 that I'm supposed to be talking about. And let me tell you what those 5 are because I have it written down so I don't forget. The ones that I've been told are good ones to have, and I don't know the company's name, so I'm just going to give you the ticker symbols. Ticker symbol RY, ticker symbol TD, ticker symbol BMO, ticker symbol BNS, and ticker symbol CM. I've heard that those are like the 5 good Canadian banks. Oh yeah, 333. I'm glad you asked this. So what about Shell, ASML? Dude, we were just talking about ASML in the Discord group earlier today, actually. I think it's really strong company. For those of you who don't know, ASML is they are a company, and excuse me as I try and explain this. They're a company that makes lithography equipment for semiconductor manufacturing companies like Intel, TSMC, and Samsung. ASML has the monopoly on this sort of equipment, and this sort of equipment they're like the only ones who make it, and this sort of equipment is heavily used by the semiconductor manufacturings to make, such small what do you call them? Semiconductors, I guess. Like and basically what it does, I'm just now learning about this stuff, so I'm a little bit fuzzy on how it works, but my understanding is it shoots light, like really precise light, onto the wafers to design the chips, and it's like the light that it shoots is like 1,000 times smaller in diameter than like a strand of human hair. So it's like very precise and very small, something along those lines. But yeah, ASML is a great company, very expensive. Shell's also a really good company too. I don't know about the valuation of Shell though. Jim says, hey, Ryan enjoyed the collab with Ari the other day. Would love to see a collab with Julie Kennedy also with tip ranks. I'll have to check her out. I'll pull up her YouTube channel so I don't forget. It's called JT Wealth. I'm not familiar with her channel, but I'll give it a look. Okay. Thanks, Jim. I appreciate you watching that video with Ari. He's a really good dude. I'm really enjoyed chatting with him. I'm stoked to do it again. Oh, Adam wants to know, how do we feel about Intel? Great question. So actually on Wednesday, I put out a video talking about why I'm starting to add more to Intel. So definitely check that out, Adam. I feel pretty good about that video. There's a lot of good stuff in there. And I'm adding more to my position. I've added the last couple of weeks in a row. And I think I'll continue buying until my average cost is under $40 per share, which if I buy for the next few weeks, well, if I buy on a weekly basis, I should be there in the next couple of weeks. Few weeks maybe. Phil do the greats. Hey Ryan, hey chat. First time seeing the live stream. Hey man, we're welcome to the stream. We're stoked to have you in here. Yeah. Chantel says, if you make a channel, just switch it up a little. Honestly, it gets very boring if the only videos someone puts out are, buy these stocks immediately. I get that, and that's like something I definitely like. Yeah, that's definitely something I feel like I've had to learn the hard way. Because I used to make, like, if you go back maybe a year plus ago, that's like what all my videos were. And, got some good views on a lot of them, but man, it's just so redundant. You got to switch it up. Yeah, Shaping here. And Shaping's got a pretty good channel too. You have to be consistent when you want to be a content creator. Number one thing, absolutely. And that's important for multiple reasons. Like number one, just to keep putting out content for the platform and for your audience. But also number two, like that's how you get better at this stuff. It's just repetition, 1% better every time, hopefully. Yeah, Shaping, thanks for adding that. Oh, Brandon. What do you think about Zim? I can't stand it. I can't stand that people buy that stock. I talked about it in a recent video titled, Avoid These Dividend Stocks at All Costs. So you want to know some more in-depth thoughts about Zim, check that out. But I'm not a fan. Let's see here. Okay, G-Man wants to know, good question. Do you still have your drip turned off? If so, how's that working out for you? Yeah, drip is still turned off. Just collecting those dividends and then manually allocating them to other positions, and I really like it a lot. Like it's been cool. Like there's been There's been some weeks, like a couple weeks ago, just from dividends coming in, I was able to invest like near $300 just in 1 week, which for me is a lot. But a lot of that came from just dividends coming into the portfolio, which felt cool. Yeah. Well, thanks, Jay. I mean, that's the thing. Like, everyone's got to do what they've got to do, and that's the beauty of, um, and that's the beauty of everyone's having their own portfolios. Is you can invest the way that you want to. I respect that we can agree and disagree, and also like I'm glad that we can all have this discourse here in the live chat, and also on the Discord for those of you who are in that. It's good to have this open conversation just to hear everyone's different perspectives. That's great. And I'm glad that Casey agrees with me here. I think it's a higher quality investment than other names being thrown around in the chat. Zim. Sorry, guys. Oh, Anthony wants to know, what do you think about central banks buying over 400 tons of gold recently? I don't know anything about it. Oh, this is a good question. Or not question. Enjoyed it when you collaborated with Darth. Yeah, me too, man. Darth's another great dude. I'd love to chat with Darth again. Me, Darth, and Russ did a video together. This was a while back now, but it was a lot of fun. Yeah, I'd love to get together with both those guys again. Let's see. Yeah, like also, Jay, you hit the nail on the head here too. You should have invested in ASML a long time ago. I know, like when I looked at that, when I looked at like what the share price has done, I thought the same thing. But then again, at the same time, like they really don't have, and this might just be due to the run up. They really don't have great dividend stats, but the company's financials look so strong. Super aggressive revenue growth, really nice earnings growth, negative debt on the balance sheet. Like it's just a great looking company with zero competition. That I don't remember who said it in the chat. Oh, no, this was actually in the Discord, but not likely to have competition for a long time either. Like it's extremely difficult to make the equipment that they do, and I would imagine pretty capital intensive as well. Let's see. Pokey DJ wants to know, Ryan, what are your thoughts on shipping companies like GEF? I don't really know. I don't know what GEF is. The only shipping company well, Zim's a shipping company. There's another one that people like. I don't remember what it is. Oh, Star Bulk Carriers or something along those lines. The two that I'm familiar with, I don't really like them. Yeah. I think they're important. Shipping's definitely like a necessity, but I haven't liked what I've seen from the two that I've looked into. Going back to RCC, Casey says, not sure why everyone's bashing it when it's expanding NII on the back of a rising rate cycle. Yeah. Yeah, I don't know. I like ORCC. Kevin, man, thank you so much. The Intel video was excellent. I really appreciate that. I put a lot of time just kind of getting up to speed on what was going on with Intel. For a while, I was kind of, I think, scared to research it or look deeper into it because I was afraid of what I'd find. But I'm actually pretty, I mean, we talked about it in the Discord, right? I don't know. I feel okay about it for now. Anything could happen, and it's going to be an interesting couple of years. But I feel better owning it now than I did before I made that video. Just being able to do some research and talk about it in the video, I think was really helpful for me, just as an owner of the company. And real quick, just talking about YouTube channels again, that is another good thing about having a YouTube channel, is it does, like, in some capacity force you to learn about this stuff. And I'm learning very slowly. Definitely learning as I go. But yeah, it definitely, if you're going to be talking about this stuff and I guess teaching people about it or sharing it, it forces you to like do your research and become more familiar. So that is like one good thing about it. Oh, there he is. Hey, buddy. He's being a very good boy tonight. All right, guys, I'm having too much fun. It's 6 o'clock. Let's go for just a couple more minutes, and I should probably wrap it up. You know what? Here, there's a lot of ORCC chatter. I just want to look at their I just want to look at the book value because I think they're trading below their book value right now. Yeah, they are. Like they're trading below their book value. I mean, I saw a brief snippet of the financials. The revenue's going up, which is great. Income's going up right here. If we scroll down to the bottom, where's the NII? Well, here's some net income. That's going up over time, pretty nice. Balance sheet's looking pretty good. I think their debt is increasing a little bit. Yeah, the debt is increasing, and the book value has been kind of flat. But I don't know. I still feel very good about owning this company for now. And like Casey said, like they're still pretty young, so we'll see what happens. Gary says it sounds to me like you might be trading out of boredom, but stick with your plan if these moves fit. No, not necessarily. I don't feel bored. I don't really feel bored. In fact, that's why I like this style of investing, is because you don't have to do much. I don't know. I'm just trying to like, how do I say this? With the two stocks that I mentioned, WP Carey and Lockheed Martin, I guess I'm just trying to make room for, I guess I'm just trying to make room to take bigger positions in some of the other stocks I would still have left over if I did sell. But at the same time, it would pave the way for me to maybe add some newer companies. I've been looking more into, which I'll talk about this more in the next month portfolio update, but I've been looking more into like smaller cap companies, some of the more under the radar companies, because there's a lot of really good ones out there that deserve to be talked about, I think. That you know, because when we watch these YouTube videos, it's just oftentimes, guys, it is a lot of the same stocks, right? Like you hear a lot of Apple, you hear a lot of Target, you hear a lot of Microsoft, you hear a lot of, you know, you often hear a lot of the big ones, and I think those are great to have in your portfolio, and you can definitely like build a solid portfolio if you just have those. But for me, it's been fun to look into some of the you know, try to find some more hidden gems, you know, stocks that aren't being talked about, and share them with you guys. Though, you know, I think KRC is one of those, actually. Well, time will tell. Bob might disagree with me, but we'll see what happens. But it's been fun, like looking and trying to find stocks that no one's heard of before. Kevin, like RHI, I think is another one of those. Robert Half, guys, I think that's another one that like is not often talked about that deserves some more recognition, you know. But you know, half the fun's finding these hidden gem stocks. So, you know, kind of. Because I have so many other stable stocks in my portfolio, maybe selling out of WP Carey and Lockheed Martin would pave the way to invest in some more of those other ones that I'm talking about. I don't know. I'm just kind of thinking out loud. I haven't, as I'm sure you can tell, like I haven't spent too much time on all this stuff, but you know, I still wanted to share these thoughts. I'm working through them. Let's see here. What else we got, guys? A couple more comments and we'll wrap it up. Yeah, so Dan, this is a really great question. Do you have any companies that you hold that are lower yield, but you hope for strong annual dividend growth over the next 5 to 10 years? Absolutely. The few that come to mind, Dan, are Starbucks. I think they have about a 15% dividend growth rate and just a sub 3% dividend yield. Snap-on is another one. They have about a 2.2 to 2.5% dividend yield, I think, and a very high dividend growth rate, like close to 20%. Lowe's is another one that is their dividend growth rate's just below 20%. I know I have some others, like even Altria Group has like a near 8% dividend growth rate, which is not too shabby. But yeah, I've got a few high growth ones that I'm investing heavily into or building bigger positions in. And then I also have some other like, you know, stalwarts, some very stable ones that I put a lot of eggs in those baskets. Like Procter & Gamble is one of my favorite companies. Not high growth by any means, but at least in terms of dividend. But yeah, definitely a stable one. So, you know, I've got a few that are lower yield and high growth for sure. Let's see. Maybe one more comment and we're gonna wrap it up, okay, fellas and ladies? Yeah, Michael, like Johnson Outdoors Inc. is a good small cap to look into. Man, you're the only, well, maybe not. I know Joel Batista, if he's still in here, he likes that one too. I first brought up Johnson Outdoors Inc. This was sometime way earlier this year. I put out a video talking about like a few stocks that you should have on your radar, and that was one of them. I mean, I don't really know a lot, and I actually just talked about them in a video earlier this month. Which video was it? If you go watch my video, let me find it. But yeah, I stumbled across that one a while ago, and it was looking pretty good. What video was that? Recently that I talked about it. Sorry guys, hang tight with me. I'll find it real quick. You know, it might have been the video that I put out this month titled "These Dividend Stocks Are About to Soar." It might have been that one where I talked about Johnson Outdoors Inc. Yes, it was that one because analysts gave it like a crazy, like 100% plus upside potential. There's only one analyst, and definitely like take that with a grain of salt. But yeah, Johnson Outdoors Inc., the financials were looking pretty good. Okay, yeah, and I think, I don't know, this is a pretty good place to wrap it up, I think, guys. Well, no, one more question. Mr. Poops wants to know if your portfolio was to over or underperform the market, what is a respectable percentage? I don't know if you can quantify it, to be honest. Yeah, I don't really know. I don't know. I don't know what a respectable percentage might be. I mean, I think you just got to take it as it comes. And I try not to worry too much about that, to be honest, Mr. Poops, because, you know, because like Casey said earlier, like the share price isn't always the most rational thing. Like the movement of the share price can be volatile for, you know, no good reason. So I don't know. I don't know if there's really a number that you can put on it, but at the same time, like over a longer period of time, you just don't want to see your portfolio continually going down. Like that's not the best sign. Because in some sense, like the share price, well, that's what they say. Like in the short term, it's a voting machine. In the long term, it's a weighing machine, right? So you do want to see over a longer period of time, you do want to see it going up because that is indicative of the businesses that you own are growing. So hopefully that answers your question. I know that was kind of a indirect way to go about it, but yeah, that's the best I got for you, unfortunately. But yeah, guys, I think this is a great place to wrap it up. We've gone about 7 minutes over, but it's been a lot of fun, like a really good stream, really good conversation in the live chat from you guys tonight. Thank you so much for tuning in with me and for, you know, hanging out with me this last hour and change. It's always a pleasure hanging out with you guys these Friday nights. And, you know, I appreciate you guys too, like pushing back on some of the things I'm saying here too. I think that's healthy. Keeps me on my toes. And it's also really great to hear your guys' perspectives on a lot of this stuff. It's very helpful. So with that, guys, I'll get out of your hair. But thank you guys once again so much for tuning in. If you have not done so already and you enjoyed this stream, guys, hit the thumbs up. And also, guys, if you're not signed up for the newsletter already, link in the description. Check it out. I'm coming to you every single week with a newsletter, basically just talking about some general thoughts on, you know, the market or investing. And then I give you some more exclusive insight into my portfolio, what I'm buying, what dividend payments are coming in. And then I also share with you some things some content that I'm consuming throughout the week, whether it's a great article on a stock or YouTube videos or podcasts. I share all the good stuff in that newsletter, and then also even answer your guys' questions. There's always a dedicated Q&A section at the end of the newsletter. So definitely check that out. Link in the description. You guys have a fantastic weekend. Hope you had a fantastic holiday, and thank you all for all of your support. I'll see you guys in the next one. Take care. Oh, tune in Sunday. Sunday's video is going to be great. It's going to be great. So tune in. I'll see you guys later.